So let's talk about the central bankers, of course, around the world, been asking the fiscal authorities to step up with more policies, stimulus and other action plans to support monetary policies that are beginning to look weak in the face of emerging global realities. So what are the economic underpinnings of Nigeria's monetary policy regime as the country holds its final MPC meeting yesterday? Welcome Johnson Chukwu, who is a policy analyst as well as the CEO at Cowry Asset Management. Good evening to you, sir. Thanks for coming on the program.
Good evening, Boston, and thank you for having me.
Thank you. I'm sure all of you analysts, economists, and policy analysts have had enough time to digest the Central Bank Monetary Policy Committee meeting and those comments by the Central Bank. Do you think the MPC has little room now to maneuver when it comes to interest rates?
What I would say is that the MPC has what the Central Bank governor called the policy dilemma, where either way they go, there's going to be unintended negative consequences. So in such situation, the windows or the headroom for pursuing any of these objectives of the Central Bank is not there. In the sense that if you want to drive economic expansion, you have to contend with unintended consequences of high inflation rate and pressures on your FX rate, reserve and FX rate. On the converse, if you want to drive price stability, which is the primary objective of the central bank, so you want to reduce the inflation rate and they want to stabilize the exchange rate, you are going to adopt a contractionary monetary policies, and those policies will lead to further slowdown in the economy. And we're already dealing with an economy that has gone into a recession. So that's why the central bank governor said in September they are facing a policy dilemma. And as it stands today, it is difficult for them to do anything that will be very drastic.
So it's been described as the elephant in the room, whatever the size of the elephant, but whatever the size of an elephant is in a typical room is going to be big, which is the FX or exchange rate. So where is the most difficult part of this, Johnson? Is it the supply side or demand side, and why?
It's basically the supply side. I do not imagine that the demand has increased. We actually have a slowdown in demand because if you look at the consumer, the level of consumer demand, which is retail sales in the country, you'll see a slowdown, which is why even if you look at the MBS report on the third quarter GDP, we saw a contraction and a recession in the trade sector. So we're not seeing so much of consumer demand, but we're dealing with a slowdown in supply. And there are three major sources of supply of FX in the economy, one of which is the sale of crude. As you could see from the MBC report of third quarter GDP, crude production in Nigeria was only 1.67 million barrels per day, which was more than 340 million barrels lower than what it was in the preceding quarter. Then we also saw that the crude price had actually dropped. It was only yesterday it has gone back to about $46 per barrel, compared to last year when we had $64 per barrel average crude price. That's one source of supply. The other source of supply is foreign portfolio investment, foreign direct investment. We are also witnessing reverse flow where foreign portfolio investors are looking for windows to leave, to exit their investments. And those are the existing that are already still trapped in the FX market. And then the third leg of the foreign currency flows into the country is diaspora remittances. And we know that Nigerians in Western countries, be it Europe, US, are all going through some difficulty because of COVID-19. So the three major sources of foreign currency flow in the country have slowed down. And that's why I say that the problem is supply. The challenge is actually supply.
So for Nigeria, is it about, let's talk about exiting the recession. Is it exiting the recession or beyond the recession? And how would you answer and why?
Well, the way I would take it is, I will approach it if I were to be a policymaker at the Federal Executive Council or the executive arm of government. I will approach from after the recession or post-recession, what do we need to do? The challenge we have today is that our economy has remained a mono-export-oriented economy. We have not seen a growth in our manufacturing sector. We've not seen improvement in value addition in the country, including value addition on our raw materials, including the extractive industry products. Take, for instance, crude oil production. Today, like I said, in the third quarter of this year, we exported 1.67 million barrels per day, we could be exporting that to align to OPEC requirement, OPEC quota. But if we had our refineries, maybe we would have also been exporting refined petroleum products. But at the minimum, we wouldn't be importing refined petroleum products and spending the amount we are currently spending on importation and the leakages we're having in our foreign exchange reserve. So the first thing is that we should look at beyond recession. How do we build an economy that can weather shocks in global shocks or exogenous shocks? And I have mentioned this repeatedly. Ghanaian economy is just economy next door to us. Their economy is not going to go into recession, despite the near similarity of our economies, because that economy grew at 6.11% last year. The growth momentum was such that even with the global economic crisis occasioned by COVID-19, the Ghanaian economy will only slow down to just about 2% growth. So the key thing is that we need to build an economic structure that is able to weather shocks, because shocks will certainly happen. And until we do that, it is not just about exiting recession, it's about post-recession, how do we build an enduring economy?
So with crude oil as the country's economic mainstay, which of course is no longer news, how much pressure do you think this places, therefore, on all the calls on the central bank to float the exchange rate?
Well, as it stands today, the pressures have been on, but it has become really pretty difficult to float the exchange. A lot of things have to, the central bank has to adjust a lot of factors if it has to allow for a more flexible exchange rate. One of which is the interest rate regime. The central bank will have to make the interest rate environment reflective or market-oriented, which simply means that in the first place, the effective interest rate must be higher than inflation rate. And we're dealing with inflation rate of 14.23%. And I think that will be difficult now because the priority of the central bank is to have a depressed interest rate environment so as to inject liquidity into the economy at lower interest rates and see if that will stimulate production. Those factors have to come into play because without adjusting the interest rates, you are not going to have flow of foreign portfolio investment that will that your floating of the currency is intended to support. And I think the current situation we have today will be difficult for the central bank to allow that flexibility. That's the ideal situation, but I think we should work towards it. It's not something we can afford to do immediately.
Johnson Chukwu, Policy Analyst and CEO at Cowry Asset Management. Thank you so much for your time this evening, a conversation that will continue.